Good evening, everyone, and welcome. My name is Dave Vidito, and I'm the Assistant Vice President of Alumni Relations and a member of the JCU class of 2000. Thank you for joining us for this session of A.C.E.S, the Alumni Continuing Education Series. A.C.E.S was established in the spring of 2013 by the Office of Alumni Relations in the spirit of lifelong learning. Program offers enrichment opportunities for alumni and friends through the expertise of members of the JCU administration, faculty, and alumni community. Now, over the past year, we have heard from experts on ethics and leadership, disruptive technology, racial equity and social justice, the war in Ukraine, Ignatian spirituality, and Alexander Hamilton, just to name a few. Tonight is one of those topics that our staff in the alumni office has had on the list and felt that now was an ideal time to explore further and learn together. That being the world of cryptocurrency. What is it? Why might you consider investing in it? What's the risk and what is its future? And how might a cryptocurrency fit into a well-diversified portfolio of other assets? Now, before I introduce our moderator, I wanted to share a few housekeeping items with you. First, we encourage you to view this program in full screen mode. And additionally, please ensure that you stay muted throughout the duration of the program. Following the moderated conversation, we will have an opportunity for questions and answers, and you may ask those at any time by utilizing the chat feature for your questions. We will ask as many to the panel as time allows, and I'll curate those throughout and pose those to the panel. Thank you, and I would now like to turn it over to our very capable moderator, Dr. Frank Navratil, Professor Emeritus of Economics and Finance. Frank?
Hi, thank you very much, Dave, and welcome to everybody who's on this presentation. It's my pleasure to be able to introduce the topic and give you a little bit of a theoretical background for those of you who may not have taken macroeconomics at one time or forgotten a lot of what you learned there, at least about money. So the two people who really know what they're talking about when it comes to cryptocurrency, and I'm very proud to be able to find these two alums. First one is Dave Kavanaugh. Dave graduated from John Carroll in 1978 and went from being a finance major at John Carroll to the University of Notre Dame to pick up a master's degree specializing in finance. And then either right after he left Notre Dame or shortly thereafter, he decided that he wanted to be a trader on the Chicago Board of Trade. And so he began his professional career as a runner at minimum wage, which was the only way back then that you would ever move up to being a trader on the Chicago Board of Trade. He progressed very rapidly because by 1983, he was a member of the board. He's been involved in trading for quite some time. He's the founder and the president of Dearborn Capital Management. They do a lot of investing or managing money for institutional clients, but they also have a public fund called Grant Park Fund, which specializes in alternative assets. Our second panelist is Michael McEwen. Michael is a 2005 graduate at John Carroll University. He is both a CPA and a CFA. He's a double major in accounting and finance. And he is now currently the chief investment officer for Markham Wealth, which is part of the Markham Group. Part of that operation is the 16th largest accounting firm in the country. And both have spent time with clients discussing the issue of cryptocurrency, and I think they have a lot to say about it. Just to get us started, to give you some background, since I'm sure there are people from various knowledge bases about cryptocurrency. The global market value of all cryptocurrency as of about 5 o'clock this evening was approximately $850 billion. That's down significantly. At the peak, I think it was around $3.5 trillion. And in fact, even a couple weeks ago when I sought out information on this for this program, there were a total of, believe it or not, there were over 1,200 different cryptocurrencies or digital currencies that acted in that space. With the problems that FTX had, I went out today and now they only list about 8,900 cryptocurrencies. So I think there's already been some fall off there. That total market value of $850 to $875 billion, the two largest cryptocurrencies are Bitcoin and Tether. Bitcoin has a market value of 330 billion, and Tether, not Tether, but Ethereum has a market value of 156 billion. So together, over half the crypto market is in those two particular assets. There are two important stable coins, and they provide a different function. That's Tether and USD coin. And together they add another $100 billion. So if you total that all up, there's only about 200 billion outside of these four currencies today, okay? Just a little bit about money. And for those of you who had to suffer through one or more of my classes, you may recall that there's three functional definitions of money. Money is a medium of exchange, which means that it's something that facilitates transactions of real goods and services. And in itself, it should have no or very little or no use value. Gold has use value. And so if you create money that basically is worthless for any other function than mediating exchange, it drives out money that is otherwise valuable. So you don't see a lot of silver or gold used as money anymore, because mainly it's currency, and in fact it's a lot of bips on bank balance sheets in a digital form already. But so the key thing there, it's a medium of exchange. Secondly, it's a unit of account, and in this regard, it means that people understand almost immediately about relative values and how much a particular item costs. Now, we in the United States use dollars, but if I asked you how many Japanese yen would it take to buy a Honda that was built in Marysville and is at a dealer's lot in Cleveland, I doubt many of you would even be given approximate value that would come close to what it would be in dollars. So that's the idea of a unit of account, is that people are familiar with how to value things because we use it so often as an exchange mechanism that we think about it whenever we want to buy something or sell it, if you will. The third thing is it's a store of value. And this means that usually we consider this to be stable, a stable asset in terms of its value relative to other things. And you can see that right now, and this is something I've really learned just the past few days, a lot with conversations I've had with Dave Kavanaugh, that right now, for most of the transactions, Bitcoin is a very expensive proposition. But Dave, I think, is going to spend time talking about Ether and Ethereum, where they're trying to drive that transactions cost down to where it's going to be reasonable. In fact, it may be less than what you'd pay with a credit card, for example, which would make a huge difference in its accessibility as a medium of exchange. So basically, I think that's all I wanted to say. Dave Kavanaugh is going to speak first. Michael McEwen is then going to take over. And hopefully we're going to have 15, 20 minutes for questions from you, because this is a very extensive area to discuss. So Dave, take over.
Thanks, Frank. Thanks for having me, and thank everyone for joining us this evening on what could be a dry topic for some, but again, I find it very fascinating. I'll try to give a brief background of how I got involved in this. And again, I think it's pertinent to the case for crypto. Is about 4 years ago, I was approached by two young men by a mutual friend, and I said I have no interest in cryptocurrencies. I think it's not what I would call a scam, but that I I had no interest at all, but I would help them start a fund, which is what they were really looking for. After a number of meetings, hours turns into days, turns into books to read. They converted me, really not trying to, that this is really a nascent technology, early stages, no doubt about it, but that I really did want to participate. Everything I've learned a lot, quite a bit from them. And, the first thing, and there's a number of things that this whole industry has to do to change to really accelerate their growth. But the blockchain's been around. First is stop calling it cryptocurrencies and really try to stick to either blockchain. And the blockchain's been around in some form prior to the advent of Bitcoin, and that's private blockchains. And Frank had said, well, what is a blockchain? I kind of liken it to a gigantic spreadsheet that gets spun around the globe, passed from computer to computer, that to verify what assets or IP are held in an account, who owns it, when they own it, and is it still there? And then it gets turned around through a number of iterations until there's some high degree of certainty that yes, indeed, this person has what he has, that he says he has or she has, and will transfer it to another. And then it takes place instantaneously. That's a public blockchain. So I got involved in this, and there are some, and we'll address the elephant in the room right now, and that's FTX. I mean, when FTX, started, I said, geez, I feel like the captain of the Titanic. He just handed me the wheel. It's very bad for the industry, but there's a huge difference here. There's a difference between decentralized and centralized management. That was a centralized, FTX was a centralized exchange offshore. There was no good regulation, and as you know, if you've read this story, there was a trading arm, and then there was an exchange arm. And this guy, just Sam Bankman-Fried, whatever his name is, he combined and basically pilfered. If the reports are right, pilfered or used it for his trading arm. And his crypto, as everyone knows, crypto has been murdered this year for a number of reasons. And that caused them to go under. And again, it's a black eye for the industry, but that's centralized. That's centralization. And the things that we do in true blockchain users, they're very reticent to keep their assets at an exchange. I mean, we have some money at Coinbase, probably 5% of our fund. And the reason it's there is for ease of use. The rest of it, we do what's called kept in cold storage. That's one of the hardest things for most people to do. You have to go out and buy what's called a ledger. You have to code it. You have to download it it's very cumbersome. So the things that I've been preaching to the two young men that I work with, and they are close, they're very well connected in the industry. I mean, there's things that we have to do in this industry if the industry is going to grow. Number one is regulation. Well, after what you just saw with FTX, I think I'm pretty confident that the regulation is coming down the pike. We met earlier in the year with an SEC commissioner, and we were advocating the use of, that we need stronger regulation. And her comments, she said, I think self-regulation is really the best. Well, that hasn't worked out so well for some of the people that kept their assets at FTX. So I do think that you're going to see actually a migration of some users to domiciles that have good, strong regulation. And that could be the United States and should be the United States. The question is it going to be the SEC or the CFTC? The other thing is custody. Custody is a big issue. And again, that goes back to, do you want to keep a USB with, 50, 100, $5 million in your desk drawer or the Northern Trust, safe deposit box? Or would you rather go to a firm like Merrill Lynch, Morgan Stanley? What you've seen is what you've seen is in the last 2 weeks, Fidelity just announced that they were starting to do institutional custody of crypto. Now, I think it's Abigail Johnson has been a huge proponent of the blockchain, and she's been mining since 2015, 14, 15. So it's no surprise that they're doing that. Again, they have to stop using the word cryptocurrency and get more into blockchain. 1 or 2 years ago, over the last 2 years, Morgan Stanley and Merrill Lynch wrote very 90, 75-page white papers that talked about, you never saw cryptocurrency in it. It was always referred to as the blockchain. And the other thing is ease of use. Once there's an ease of use, you're going to be able to see much greater adoption. And getting to the thing that Frank mentioned earlier about ease of use, I think there's this misconception that there is no use for the cryptocurrencies or blockchain assets, that they're just, I went out and said, okay, I'm gonna float the Kavanaugh currency, and I'm gonna be the king of Kavanaughville, and that's it. And let's see if somebody's willing to buy it. Normally what's happened is there's a white page published, and there's an algorithm in that says exactly how it's going to trade, exactly how we're going to monitor the token as far as the expansion and or contraction of the outstanding tokens. And you can choose whether to adopt it or not. But more often than not, what you're seeing, and Frank pointed out, that the whole industry is dominated by two main: Bitcoin, which I say is considerably different than the rest of the cryptocurrencies or tokens, blockchain that is out there. Bitcoin truly is recognized as digital gold. And some of the shortcomings of Bitcoin, its ease of use, the high degree of computing that it necessitates, is a drag on its use as a functional, what we call a level 1 platform. Now, after Satoshi Nakamoto, I believe, is the pseudonym that was used when that was floated 13, 14 years ago, after someone took a look at it and said, that's a fascinating concept to put into the public domain, but I'm going to improve on it. And Ether was launched. It might not have been the second one, but it was the one that was most adopted and is the most adopted now. So when you look at Ether, I wouldn't look at it as to use the name cryptocurrency. It has value. It's a transactional platform. So you see a lot of other blockchains that will say it's highly used. It's very flexible in its use, and I will write to their platform, and will be able to transact through them. And it's a mistake to not think that it's not being used right now, the blockchain, for commercial purposes. And I mentioned this, and this is what he said what he mentioned. My partner has a credit card issued by Visa tied to his account at Coinbase, and he has it in what's called a stable coin. Frank mentioned Tether. Tether is the largest stable coin. It's consider it like a money market fund. It's tied, and its value never fluctuates. At least it shouldn't. And it's $1. So he can go to London, let's say, or anywhere in the US for that example, pull out his Visa card. It's like a debit card. It will debit directly his Coinbase. Now, here's the nice part for the vendor. If the vendor takes it, and this is what I mean when it's going to take, I think the adoption can happen quite quickly once the ease of use and custody is solved. And there's a level 2 provider on Ether that will do it for about 45 basis points. Let's say there's another 45 basis points in fees. So the all-in fees to a vendor, or let's say a restaurant, a store, is round up and say 1%. I don't know what the normal credit card costs are, they're probably somewhere between 2 and 2.5%. So for a retailer or a restaurant or anyone that will accept a credit card, you've now cut your transaction costs in half, and you get paid the second that guy rings it through. The money hits your account. You're going to have a wallet as well, or an account at Coinbase, and you get paid immediately. And so that's just one use case. You can actually trade some stocks on the blockchain, and they stay on the blockchain without ever having to take custody of them, and or go through an intermediary. It's so there are a number of uses in the blockchain that that make it, like, I would liken it, and if you can imagine this, consider Ether like Amazon. It's an aggregator where a lot of these use cases can and will go to be able to transact on. And one of the things Frank wanted me, now Bitcoin's a totally different story. It's very clunky. They've been trying to solve the speed question and processing there. And by that, I mean, if you went to a restaurant, this is the analogy one of my partners uses, and you wanted to use Bitcoin, a level 2 token that trades on Bitcoin, you'd probably have to ask for the check in the middle of the meal in order to get the process done by the time you want to finish. For Ether, now that they've gone to what's called proof of stake, you can ask for the check, it'll process it within 2 seconds, 3 seconds. So it's much faster. And I think that's why that will become the dominant user of the blockchain technology. But Bitcoin has a ferocious following. I don't want to get into an argument over is gold valuable other than it's gold. But Bitcoin, there's a book out, Digital Gold, and a lot of it has to do with Bitcoin. I consider that digital gold. It's much different than the rest of the blockchain and the other tokens you see out there. So my opinion is Ether will win over, and at some point in the next, I don't want to guess, will overcome Bitcoin as far as its market cap goes. The one thing that Frank did want me to emphasize is that all these blockchains have algorithms that are identifiable, that are very transparent, and they have, again, not to get into money and banking, but a lot of people think we're spending we're issuing far too many dollars right now. We're issuing money out of control, and I think that was the reason why Satoshi founded Bitcoin. In this particular case, and Frank, I went back. Bitcoin halves every 4 years. They call it the halving, and so if you start with a supply of X, every 4 years they cut it in half, and that should correspond to a change in the number of price. Ether is a bit different. Ether, it's set, but for every transaction, first of all, I'll back and say there's no more mining in Ethereum. You have to be a stakeholder, so it's called proof of stake. So if you want to get rewarded for helping go through the transactions, you have to go out and buy Ether tokens. And then by doing that, you can get rewarded for using your computers, your nodes to process it. And then every time a transaction takes place, a little bit of that Ethereum blockchain is nibbled away. And when they were explaining this to me, I said, well, Luke, if this is the case and there's never any expansion, you could actually go to 1 Ethereum left in the entire world. And he said, yeah, that's correct. Now we will all be dead by then. But what happens is those rewards are not, they're dynamic, not static. So if the price begins to go, parabolic, or at least substantially higher on a linear basis, the rewards will be cut down. And they also reflect interest rates. They also reflect costs. But when they went to proof of stake just this September, you hear a lot of people say, well, it's way too expensive. This is energy inefficient. 98% reduction in the energy cost to transact on Ethereum. So, I think we've been in a bear market. FTX and some other blowups this year has caused some significant problems. But I think on a go-forward basis, I think there is opportunity here. I think I saw a statistic today. How many users? There's 300 million users of Bitcoin in the world today, and they expect in the next 5 years that could go to 1 billion users. That's 12% of the world's population. If you use the same progression that we've experienced. So I don't think it's going away. I think there's problems that need to be solved. But as a diversifier, well, look what happened this year. Bonds, stocks, all down. Stocks have obviously come back a bit. Crypto down big. So it wasn't a good diversifier this year. It was a risk-off appetite for most of the world. But I think there might be some more downside here. I don't want to predict, but I'm still very bullish on adoption and the program going forward.
Thanks, Dave. Michael?
All right. Well, thanks, Frank, and thanks, everyone. Definitely appreciate you hopping on this evening. Just to give you a little background on really how I came across crypto and Bitcoin originally was in the summer of 2017. We had an intern that was in our office and had been a very early adopter of Bitcoin. And so I started to learn about it that summer. And subsequently continue just a journey of learning about what's going on in crypto, talking to the custodians that were mentioned, like Fidelity. Talked to them a couple of years ago about their platform, hedge funds that are investing. Because I sit in this chair where people ask me, because we oversee a few $1 billion in assets, and say, what should I do? How should I think about this? And so, I had to really to learn and have an opinion, because that's what we get paid to do. And, I think my role here is a little bit more of the devil's advocate in terms of how I think about crypto and how thinking about other digital assets in general. But I want to back up, I guess, a little bit and say really to what Frank's original definition of money as a means of exchange, and really why and how this, I think, came about in the story. And part of that was the store of value that people wanted. We've all seen that chart. When you go back the last 100 years, a dollar is worth 1% of what it used to be because of inflation. And people are upset about that. And if you go on and read about Bitcoin or talk to folks, they really align with the Austrian school of economic thought, which more or less believes that you should have a hard currency that is backing your monetary system, meaning gold. And we've done it. We actually had that happen for a long time. We had a gold and quasi-gold standard prior to the 1930s. However, there was a big problem that they discovered. Having a shiny yellow metal back your economy and your currencies didn't allow you to stimulate your economy. And so throughout the 1800s and early 1900s, we had depressions every couple of years. They actually had to come up with the word recession in the 1930s because the word depression kept happening over and over again. And these were bank runs. These were massive unemployment. And so I think the government be able to step in a crisis period like we saw during COVID, so that we don't have 15 to 25% unemployment is actually a good thing. And the US was not the only economy to do that. It happened all over the world to avoid the longer term negative economic consequences of that. So I look at that as a feature and not a bug of the system, and kind of a bug of these hard currency backed systems with a fixed supply. Now, it's certainly great though for looking at assets, because certain assets do have a fixed supply. Real estate, the stocks, a certain number of stocks listed on an exchange, you can only buy so many shares before you own 5-10% and start to push the price around. So I think that's how we started to think about it. And what seems like has happened over the years is that the crypto community is rediscovering a lot of the problems that traditional finance has already dealt with. around custody, around leverage in the system and speculation and the trust that you need in a system. But what's, I think, been frustrating for me as someone that is looking for ideas to invest in portfolios and looking for diversifiers is just how much the narrative seems to change every couple of years. We have, it's been a store of value. It's like gold, but it's more transferable. But then, it doesn't always really move with the price of gold, and it is different. It's uncorrelated, but now it's an uncorrelated asset that mixes well with portfolios. But it's had a 0.8 correlation to the NASDAQ over the last 5 years. Now it's had that 0.8 correlation. So almost moving in tandem, however, at 5x the rate and 5 times more volatile. We've heard that it's an inflation hedge, but in a year with the highest inflation in the last 40 years, it's gone down because really these assets are digital assets for speculating at this point. In terms of what I've seen, there's certainly some use cases where there's getting more blockchain or more cryptocurrencies and earning points and everything within the system, but we haven't yet seen, I think, it making it into the real world. And that's where I'm trying to see, where is it going to be in 5 years that the average person is interacting with this system beyond, speculating on the line going up on a screen and actually generating real value for the economy, for companies. And, again, goes back to what I was traditionally trained as an investment analyst and in thinking about cash flows. And what I learned in the John Carroll Finance program is that you could look at cash flows, you can discount them back. So if you give me a stock, bond, or real estate, I could give you a good idea of what return you might make. But I have a lot of problems doing that with this asset class that one can have an unlimited supply. And unfortunately, I was just thinking as we were talking or listening, thinking about SBF, there was an infamous podcast on Bloomberg's Odd Lots where he about 6 months ago described the magic box. And so creating a magic box and saying, well, this is now worth $1 and I just minted 20 million. Therefore, it's worth $20 million. And that was some of the collateral that backed it. And so I think that's a lot of those 8,900 securities or 8,900 assets, they need to prove their value. Now, there's certainly some ways that they can do that over time, but I think the onus is still on them to prove that's going to make an impact on society overall, because I think people are thinking, how do I participate? How do I make money in this? But I think there has to be a there. Over time, we're going to see more trading systems potentially that use the databases, and ultimately these are databases, right? We use databases every day in our lives. The banks know how much money I have in my account. They know the county auditor knows who owns each piece of real estate. That's a database, maybe a very outdated one if it's on a piece of paper, but it's there. And potentially maybe there is some disruption. That's been a case that I've heard a lot around Bitcoin is, getting rid of title insurance, because we all have to pay $350 when you go buy your new house. And that doesn't seem like it adds a lot of value. But I think, what we're seeing now is a little bit of the changing of the branding to Web 3.0 to digital assets. I do think digital assets is a more apt description because that's what they're being used for. They're obviously all on a digital platform and they're available through those means. But I think what they do need, though, is more people have to buy in for these numbers, for the lines to go up. And I'm looking for valuation frameworks to try to think about this. There's the S curve and the adoption curves to think about how to value and put a price tag on what should this asset be worth, other than what is the fundamental reason it should be worth something. So I still haven't found that. There's a cash to flow model. There's Metcalfe's law, which is the users times the transaction value. I think they're interesting, but I still just haven't gotten one that's got for me to become a believer, which I kind of think you have to be or you don't have to be. And I think that's for kind of everyone to decide and kind of look at the evidence and really how it aligns with kind of your view of the world. The one thing I think Dave did a good job talking about is custody. And, when clients have come to me and what I've been worried about, even with platforms, I've talked to the Fidelities, I've talked to the firms that work with Gemini, and the custody is such a big issue. It's, as an investor, I don't underwrite the risk that someone's going to abscond with my money, I know what we have at the custodian where we own our stocks and bonds, and the administrators where we hold alternative assets. And that's something that is a very big challenge, even for cold storage for hedge funds. I mean, they have to have, it's kind of like, launching a nuclear missile to sometimes access some of these dollars, because somebody could run off with it if they don't have the right risk management systems in place. So I think those are problems that need solved still, and I'm hopeful for it, because I hate to see people lose money. It really does not, bring me any joy, especially when people are taking it as we've seen. And what I'm worried about is that this is continued to go on, and there might be more underlying stories, and some of the crypto pump and dump schemes that happened. I think we're going to see a lot more regulation, and potentially people go to jail for some of the things that have happened, because I think they broke some laws, and they're going to be cleaning it up. As it relates to sizing the investment, I don't want to put that roughly $1 trillion in perspective to the rest of the global investable assets, because one thing that is important when you're investing is thinking about sizing an asset. So 1 trillion sounds like a big number, but when you add up all the stock markets around the world, we've had a little bit of a sell-off, but we're roughly at about $125 trillion in total equity assets. The fixed income market is about another $126 trillion. So we're at 250. Globally, commercial real estate is worth about $40 trillion, I think about 38, according to Jones Lang LaSalle. And then gold, we'll put gold in there at roughly 12. We'll maybe exclude private equity and venture capital, but that's another 10. So we'll say 300 trillion. We've got 1 trillion of assets. So it's 3/10 of investable assets. Bitcoin at $330 billion is the value of Home Depot. So I know we talk a lot about Bitcoin and speculation, but we should talk more about Home Depot is my point. But nonetheless, I think it's super interesting. I think it boils down to, is this a speculative bubble that has gone on in the past, like the Dutch tulip bubble in 1600s, the South Sea bubble, Japan real estate, or maybe it is a bubble like the technology bubble that we saw in 2000, but companies grew up, the industry grew up, and created a lot more profitable entries. But I think that's going to be for shareholders to decide, for people that are creating these companies that are going beyond creating places to speculate and use leverage, that are creating value for the users and the people. So I'm hopeful that that'll come about in the future.
Terrific. Thanks, Michael. Dave, do you want to lead off with some of the questions? I see we have just a couple in here. So
yeah, no, we have some great questions submitted by the audience, and really about 20 minutes left, so this timed up perfectly. So I'll just go through the list, start with the first question that was submitted. Is the underlying Bitcoin liquid enough to be borrowed and sold short? Is there a screen that shows the investor how much of the float is borrowed and sold short?
Well, the easiest way, I'll take that, I guess. The easiest way to sell it would be to sell it. Well, yes, you can go to and you can do it on the blockchain and find a counterparty that will be willing to let you take the other side of the trade, so to speak. But, personally, the easiest way to do it is you can use the Board of Trade contract. There's a liquid Board of Trade contract that'll allow you to short. You don't have to borrow anything. All you need to do really is have the wherewithal to open up an account with a futures clearing merchant at the CME. And I said Board of Trade. It's now the Chicago Mercantile Exchange, and open, and away you go. You get a quit. You just get a quote and hit the bid. It's the longest part of that is going to be opening the account. So it can be easily shorted.
Thank you. I'm going to jump to one maybe more for Michael, and it's a little bit longer, so I'll try and synthesize the concept here. But it really leads off by saying, discussing the dark past of the origins of crypto, kind of a tool of the dark web is how it's phrased here. So the question is more, kind of how did we get here, and really, what does it do that traditional governmental currency cannot do as well and more consistent with societal interests and values?
Yeah, I mean, I think that's really the amazing thing about this concept is that the original investors, people that were the insiders, I guess, and the marketing and machine of digital assets of Bitcoin, we're able to get so many people to assign some value to it. And, things are worth whatever people will pay for them. You may you may be familiar. We've had a bubble in a lot of assets, including baseball and basketball cards over the last couple of years. They've gone up dramatically. You might say, well, why would I buy a Ja Morant rookie card? Well, it's worth like $1,000. So that's what people are willing to transact it for. So, there certainly, I think, are the nefarious transactions that are going on. From what I've learned, is that it's actually very easy to track people. It may be a foolish thing to complete nefarious transactions on a publicly distributed ledger system that everyone can see. But I think it did start out with like that. And I kind of just reiterating my point, I'm hopeful that we see some ability that more societal interests, there is the ESG folks that are saying how much power that we're using to confirm these transactions. But that is the challenge. And the government really does take, another currency very seriously. And, that's something I've thought about as well, and talking and learning about, and how governments could really intervene and change. One, they could change the taxation of an asset. For example, what if they made Bitcoin a mark-to-market gain in your portfolio? So even if you didn't sell it, you'd be taxed on the gains, because that's actually how corporations are taxed. That could really hurt the liquidity. They could outlaw it. They've outlawed gold in the past. If they really thought it was a threat to the government, at this point, you can only extinguish your income tax liability in US dollars. They don't accept gold. They don't accept Bitcoin. Some states, ironically, actually do accept Bitcoin, but I think they were just trying to recruit companies to their state. But the federal government wants demand for dollars, and they have, especially the US dollar has the major privilege of being the world's reserve currency. So we're able to, stimulate economies and our economy and move markets around the world. So I'll stop right there. I feel like I'm rambling a little bit.
Oh, that's great. Thank you. Thank you. The next question, and we have a few minutes left. So if you'd like to get a last question in, one or two more, we might be able to fit that. This is the question is the blockchain somewhat analogous to depository trust and clearing companies' function of storing and securing paper stock certificates?
No, right now it doesn't have that capability. And, again, what both myself and Michael have emphasized is the lack of good custody right now. I think, short of taking it off the blockchain and putting it, as Michael said, into cold storage, it can't replicate what the DTC has. But again, that kind of segues back into some of Michael's comments and, a case use of this. If everyone remembers, a lot of what the blockchain is trying to do is try to decentralize finance. They call it DeFi to some degree. And, Mark Cuban is a big proponent of the blockchain, but that doesn't mean he's right. But remember when GameStop was trading wildly to the upside, there was a monstrous short squeeze. And I think it cost you, if you had to cover your shorts or you were trying to short it, the repo cost was something like 20 or 30% to borrow the stock. And, he put out a tweet saying, repo GameStop, 30% borrowing rate. How do you say DeFi? And I think his point there was that if we could get to the point where you're having, a DTC type thing, and you had GameStop, his point, and I think he mentioned Goldman Sachs in that as well. Why should Goldman Sachs make 30% when, because you give them if you're on deposit, you have your equities on deposit somewhere, they usually have the ability to hypothecate those, and they get the income from that. why shouldn't a fellow that has 500 shares of GameStop be able to do that and reap the 30%? But we're talking about something, years down the road from a maturity aspect. But that is really what they're trying to do, is to replicate some businesses that don't need to be centralized. But, as I said, there's a lot of hurdles to overcome there. And the other thing I sat here nodding is Michael's 100% right. You really have to be a believer of this. You can't, if you sit there and we all sat around last year saying this thing is really getting ridiculously frothy. It's getting evaluations that don't make a lot of sense. I think it's come back down, but it does have to prove itself, just like any company has to prove itself. Certain, blockchain entities have to prove themselves. So it's not that different, but there are metrics that you can look at. But Michael's right. You have to be a believer to get involved in it.
Great. Maybe right back to you, David, but anyone can weigh in as well. Is there a liquid forward market and yield curve for Bitcoin?
I guess I wouldn't say there's a forward market. There's certain trading desks and trading firms that'll make you an options market. I've never really, honestly, I don't want to misstate what the circumstances are. I know I've looked at pages of option valuations going out if they wanted to buy in. But getting to Michael's discussion about volatility, the volatility has been historically so high in this. The options pricing component of this would be, is very, very high. So I'm not familiar with, a forward curve like there is in foreign exchange. I wouldn't doubt it, but I'm not that familiar with the Bitcoin market, to be honest with you.
And for either of you, going forward, is there a book recommendation? Is there an online publication that you would point to for people who want to continue to learn more, read up on digital assets and cryptocurrency?
Dave, maybe I can handle that. My colleague, Bill Elliott, who's the Department of Economics and Finance chairperson and Mellon Shareholder in Finance, sent an article to me, which I thought was fairly interesting. It's meant for college students to get an introduction to cryptocurrencies. It's called 3 Modules for Introducing Students to Cryptocurrency Risk and Returns. And the first, it's in 3 parts. The first part basically describes the market, much as the gentlemen who are with us tonight know very well. And then it talks about risk and return and how you can get information on that and calculate those 2 features. And the volatility, which Dave talked about, and I think Michael, you mentioned it as well, is very substantial. So that's one of the current problems, is that and Dave's in the market of looking at alternative assets. Why? Because it fits into a more standard portfolio of stocks and bonds. And what you're hoping to do is have just a slight reduction in your returns, but have a substantial reduction in your risk profile. And I don't think, as of yet, there's been, and this example was given is in Bitcoin. I don't know if Ethereum is a little bit better, but the risk factors are still really high when you look at the empirical information. Okay, so that's an article. I'd be happy to send it to anybody who sends me an email message saying they'd like to get a hold of this. It's just my last name, navertil@jcu.edu. 2 other things I think that I found very interesting just in the last couple of days. There was an article in the Wall Street Journal on Wednesday, which I guess was yesterday, by David Solomon, who's the CEO of Goldman Sachs. And the article is entitled, "Blockchain is Much More Than Crypto." It may have a different title if you go out to the Wall Street Journal website, but just look for David Solomon. It was an opinion piece. I thought it was very well done. And after having talked to Dave Kavanaugh that day, it sort of reiterated some of the things that he had to say about the blockchain and cryptocurrencies. And then I think this morning on CNBC, what's his name, O'Leary, the guy who's always on Shark Tank, he got paid $15 million to be a spokesperson for FTX and ended up losing like $9.6 million. And there was a really good exchange about his role in that whole debacle. And I think, again, if you're interested in this area, those are some things that might help educate you.
That's great, Frank. Thank you. Thank you. Well, any final thoughts from the panel, from you, Frank, the moderator? There are a few more quotes in the chat feature, not so much questions. So I encourage all to kind of page through that and look through those. But any last words from the panel or Frank?
Yeah, I would just say, just to kind of answer and play out the last question, is in terms of resources, I've read some books on Bitcoin. There's a ton of articles out there. Twitter is very active. You got to be careful. I would just encourage people to get all the sides of the story. Kevin O'Leary, when somebody's paycheck depends on it, what view they're going to have. So, get a variety of views so that, you can make informed decisions and just continue to learn about the space. And there's tons of it out there. So feel free to ping me if I can send you some as well.
Yeah, and that's, I'd say the same. There's just an enormous amount of material you can find on the web, whether it be on a specific blockchain, what's happening, any news. You can't be too careful. You do have to have a certain risk appetite to engage in this, and I certainly wouldn't get out over my skis as far as how much you invest. But I don't think there's any rush. I think we just came off of a extraordinarily break, and I think it'll chop wood here for a while. And if it does get some legs, I think you'll have plenty of time to get in. But do it carefully and do a lot of reading. I mean, I had the ability and the wherewithal with having two guys sit in my office for hours on end educating me. So that was almost as good as Frank Navratel's classes.
Well, that's a great way to end it. Frank, a final word from you before I close it out.
Not really. I hope this was both educational and entertaining, and not a waste of your valuable time. I certainly have a tremendous amount of respect for Michael and Dave Kavanaugh, and not that I don't have respect for Dave Vitito as well, but no, I know I learned a lot just in preparation for this, and I like both of them. I've been studying this for some time, and I still felt that I was a real neophyte until I had some conversations with them. So thank you for attending. We really appreciate it. And go Streaks.
Thank you. This was tremendous, really. So thank you, David, Michael, and Frank. And thank you all for joining us this evening for a robust conversation on an important societal topic. Really, the point counterpoint was tremendous. This is one of the best ones we've ever done. So a tribute to you and the panel, Frank. I will close in the spirit of the holidays by asking you to please consider a charitable gift to John Carroll in support of our students, our faculty, and our entire campus community. We'll even take it in crypto if you need to do it that way. If you've already made a gift this year, we thank you for your generosity. And if not, please join me in supporting our alma mater at jcu.edu/give. So we can continue to deliver an outstanding education for future generations of Blue Streaks, just like the ones you heard from tonight. Thank you all again for joining us. Take care be well, and onward on, John Carroll.